Imagine you're just watching the crypto order books, right? You're analyzing the charts, you're tracking the sentiment, and suddenly, out of nowhere, a ghost wakes up.
Oh yeah, the absolute worst nightmare for retail traders.
Seriously, I mean, we are talking about an OG whale here, an original player who has been completely dormant, just, sitting quietly in the shadows for 15 solid years, and then they suddenly move.
Right, and it wasn't just a test transaction either.
Exactly. They didn't just move a little test amount. They hit the sell button for 12,000 Bitcoin. That is nearly $1 billion deployed right into the market in just a few massive transactions.
It's massive.
So the immediate question for you as a trader listening right now is, when a $1 billion ghost wakes up and starts unloading, do they know something we don't? Do you follow them, or do you just run for cover?
Well, I mean, it is exactly the kind of event that completely short circuits the average retail trader.
Oh, totally.
They see $1 billion hit the bid side of the exchange, and they just imagine this impending price crash. And, blind panic just takes over the steering wheel.
And that is exactly why we are here today. Welcome to Bitcoin Deep Dives by MyCryptoParadise. And hey, if you are listening to this right now, consider this your reminder that you are part of the Paradise family now.
You're definitely not alone in this.
Right, you aren't navigating these incredibly volatile waters by yourself. Today, our mission is to take the absolute latest market update from the Paradise team's lead trader, Simon, and really extract the blueprint for the professional trading mindset.
Yeah, because we really need to look at the exact behavioral science of trading here.
Okay, let's unpack this, starting with this $1 billion shadow, because Simon noted that the Paradise team tracks this specific smart money very, very closely.
Right. They aren't just looking at the price of Bitcoin on a screen.
No, they're looking at the exact blockchain addresses this whale uses. They even track when this specific entity is using leverage.
Which, honestly, is exactly how a professional desk operates. I mean, they function essentially like a hedge fund. Because we have to look at the sheer mechanics of a 12,000 Bitcoin sell-off.
It's a logistical nightmare to sell that much.
Exactly. You can't just drop $1 billion onto an exchange without devastating the current price. There simply aren't enough buyers sitting right at that exact market price to absorb it.
Right. It causes massive slippage. The price just, cascades downward as it eats through all those buy orders.
Yeah. So if a 15-year-old whale is willing to trigger that kind of slippage and they aren't waiting for higher prices, it means they are trying to exit aggressively.
Meaning they don't care about the slippage.
Right. It signals one of two things, really. Either it's a massive strategic diversification of their assets, or they are trading on asymmetrical information.
Like they know something bad is coming.
Exactly. They believe the market is about to drop significantly. And either way, when smart money is aggressively seeking exit liquidity like that, professionals immediately change their posture.
But, here's what I really want to understand about the human element here. I like to think of it like an analogy, right? If the crypto market is this dark ocean, retail traders are just sort of swimming blindly, reacting to every single wave that hits them.
Splashing around.
Right. But a professional trader is in a submarine. They are actively tracking the giant squids, these whales on sonar. So if the blockchain data is public and the sonar is pinging, how does human bias make regular traders just ignore these massive warning signs?
What's fascinating here is how our psychological need for safety actively destroys our portfolios. I mean, Simon uses this concept of the market acting as a predator hunting sheep.
Which sounds super dramatic, honestly, like a trading cliche.
It does sound like a cliche,
Yeah.
but mathematically it's very real because right now there's a massive cluster of retail capital, what we in the industry call a liquidation heat map, sitting right around the $74,000 mark.
And Simon explicitly warned about the danger of positioning short stop losses right below that $74,000 level. But mechanically speaking, why is everyone's money clustered there in the first place?
Because of the behavioral bias of anchoring. You see, the human brain loves round numbers,
Oh, absolutely.
and it really loves recent historical highs. When a retail trader, the gambler, basically looks at a chart, they don't look at the underlying momentum. They look at the recent high of $74,000. They anchor their brain to it, and they just follow the herd.
Right. They place their stop losses right below it.
Yeah, they're seeking the psychological comfort of just doing what everyone else is doing.
They want the safety of the crowd.
Precisely. But the market predators, the algorithmic trading bots, the institutions, the whales who, need to offload $1 billion, they do not trade on comfort.
Right. They don't care about feeling safe.
They trade on liquidity. Remember how we said a massive sell order causes slippage? Well, the only way a whale can sell massive amounts without crashing the price on themselves is to find a massive pool of buyers.
Oh, I see where this is going. And a stop loss on a short position is literally an automatic buy order.
Exactly. So the algorithms purposely drive the price toward that $74,000 cluster just to trigger all those automatic buy orders. It provides the exact liquidity the whale needs to exit.
Wow. That is brutal. So the retail trader's psychological need for the safety of the herd literally turns them into the exit liquidity for the smart money.
Yep. They are providing the meal. That's just the reality of the mechanics.
So if the algorithms are actively hunting that herd liquidity, how does a professional actually map the environment? Because, I mean, they can't just stare at a heat map and guess when the predator is going to strike.
Right, you need a framework.
Exactly.
Yeah.
And this brings us to how Simon translates these raw chart movements into actual human psychology, because he talks about the market having this breathing pattern.
Yes, he's utilizing Elliott wave theory here, which at its core is basically the mathematical mapping of mass psychology. It proposes that markets move in 5 steps forward, which is driven by greed, and 3 steps back, which is driven by fear. And Simon breaks this down beautifully into inhales and exhales.
Yeah, the inhale is that powerful, greedy surge in price, right? The motive wave. And the exhale is the corrective wave driven by fear.
Exactly.
And Simon pointed out that after we hit the $74,000 mark, the market really started its exhale. Like, we dropped from around $76,000 down into a major support zone starting at $67,000.
And this is exactly where the behavioral science kicks into high gear. Because Simon identified this specific exhale as a WXY double 3 pattern.
Right.
Which functions as a very deep zigzag correction.
Okay, wait, before we go further, let's define that for the listener. What exactly does a WXY double 3 actually look like on a chart, and, why does it matter?
Great question. So a WXY double 3 is a complex correction instead of the market just dropping cleanly in a straight line.
Which would be too easy.
Right. Way too easy. It drops, then it bounces a little to give retail traders false hope. Then it drops again, bounces again, and then drops a third time.
Oh, wow.
Yeah, it's essentially chaining multiple corrective patterns together. It creates this choppy, frustrating, sideways to downward movement. And in this case, it retraced at least 50% of the previous upward surge.
So mathematically, it's just a complex 50% retracement, but psychologically, man, chopping downwards like that must be devastating.
Oh, it is designed to be devastating.
Yeah.
A 50% drop, wrapped in all that false hope, feels like the sky is falling to a gambler. Panic sets in.
They start sweating bullets.
Exactly. They get chopped up buying those fake bounces, and eventually they just capitulate and sell everything at the exact bottom.
That's true.
But Simon explains that for the market to actually function, a deep exhale is fundamentally required. You have to empty the lungs completely to prepare for the most powerful next inhale.
Right, which in Elliott wave terms is the higher degree third wave.
Exactly. The professional knows this WXY pattern is just the market preparing its lungs. But the gambler thinks it's the end of the world.
Which perfectly sets up Simon's use of the Mass CD indicator. Because while the price was pushing up toward that $76,000 high, Simon pointed out that the Mass CD was actually printing lower highs.
Yes, that is the classic bearish divergence.
Right, and let's explain how that works, because Simon used a brilliant analogy here. Mass CD measures the relationship between 2 moving averages of a price, right? A short term and a long term. When those moving averages start getting closer together, it means the underlying momentum is dying, even if the price itself is still inching up.
Right.
And Simon compared it to driving a car up a really steep hill while you're actively losing fuel. Like, you're pressing the gas, you hear the engine going vroom vroom to the upside, but the tank is emptying. Eventually, gravity is going to take over and pull that car backward.
It's a perfect mechanical analogy. The price is the car, and the Mass CD is your fuel gauge.
But let me push back on human nature here for a second. If the dashboard is clearly showing the tank is on empty, I mean, we have a bearish divergence. The moving averages are crossing into resistance. Why is the gambler's instinct to just keep their foot glued to the pedal? Why don't they just pull the car over?
Because of the dopamine loop of variable rewards.
Oh, interesting.
Yeah, it is the exact same psychological mechanism that keeps someone pulling the lever on a slot machine. When the car is inching upward, even with zero momentum, the gambler's brain still releases dopamine.
Right. They see the green candles.
Exactly. They see the green candles, their portfolio value ticks up a fraction of a percent, and their bias for constant action just completely overrides their logic.
The FOMO kicks in.
Yes. The fear of missing out convinces them that if they take their foot off the pedal right now, they will miss the summit of the hill.
They're just trying to squeeze every last theoretical drop out of an empty gas tank.
Exactly. But a professional operates on data, not dopamine. When a MyCryptoParadise trader sees the MACD histogram printing lower highs, they recognize the car is stalling.
They don't try to force it.
No, they don't try to force the trade. They pull over, they secure their profits, they just sit on their hands and wait for gravity to do its job.
So if our brains are chemically wired to keep our foot on the gas because of that dopamine hit, how do you logically force yourself to pull over? Like, what does the actual playbook look like?
Well, you need strict rules.
Right, which brings us to exactly how the Paradise team executes their strategy without letting emotions hijack the steering wheel. Because Simon dropped a rule that I think fundamentally redefines risk management.
Oh, it really does.
He said, and I quote, "What's mostly important is not when you buy and when you sell, but how much you buy when you buy and how much you sell when you sell."
That right there is the core of professional trading. Gamblers are obsessed with prediction, you know. They want to guess the exact future of the asset.
They want the crystal ball.
It's exactly. But professionals know the future is inherently unpredictable, so they focus entirely on position sizing and exposure. That is literally the only variable you actually control.
And Segman laid out two very strict, totally emotionless options for how he plans to re-enter this market. He is not just firing blindly. Option A relies on gravity.
Right.
If the price drops down into his target liquidation zone, which he identifies between $55,000 and his magical number of $44,000, he starts accumulating aggressively.
And he didn't just pick those numbers out of thin air either.
No.
That $44,000 to $55,000 zone represents a massive confluence of historical data from both the 2018 and 2022 market cycles. It's an area of immense structural support.
Right. But then there's option B. And option B is that the market proves the bulls are strong, the smart money steps back in, the structure turns undeniably bullish, and they ride what he calls the ultra cycle third wave all the way up toward $169,000. But here's where it gets really interesting for me, and I have to challenge this logic a bit. Option B literally means waiting for the market to prove it is bullish.
Yes.
Which inherently means you are buying at a significantly higher price than where we are today. Doesn't that defy the oldest rule in investing? Aren't you sacrificing massive profit margins by waiting to pay more?
If we connect this to the bigger picture of probability, you've just highlighted the exact ego trap that destroys amateur portfolios.
Really? An ego trap?
Oh, absolutely. The gambler's ultimate bias is their ego. They have this obsessive, burning need to catch the absolute exact bottom of a market crash so they can feel like a genius. They want the ultimate discount.
Ah, the classic catching a falling knife.
Precisely. Right now, as Simon pointed out with that WXY double three pattern, the trend is still technically pointing downward. The momentum is bearish.
Right.
So if you buy right now just because it feels cheaper, you are just guessing. You are literally stepping in front of a freight train and just hoping it stops.
Wow.
The professional trader doesn't care about the ego trip of catching the absolute bottom. They care about risk-adjusted probability.
Okay, let's break down risk-adjusted probability in this context.
So waiting for option B means you are voluntarily paying a slight premium for confirmation. You are giving up the first 10% or 15% of the move to buy the data that proves the smart money has actually arrived.
Oh, I see.
A gambler will buy at a 20% discount with only, say, a 30% chance the market goes up. But a professional will gladly pay 10% more for a setup that has an 80% chance of continuing upward to $169,000. You are paying for the safety of the trend.
Wow. You are paying a premium for confirmation. That completely reframes the whole concept of buying high. You aren't buying high. You are buying the data.
Exactly.
But honestly, having the discipline to sit on your hands, watch the price drop, and deliberately wait to pay a premium requires serious mental conditioning.
Which brings us to the most powerful part of Simon's update, in my opinion.
Yeah.
The Paradise Team mantra.
Oh, it is an incredible piece of psychological armor against the exact biases we've been discussing today.
I really want to read it out loud for you, the listener, because this is how you actively rewire your brain to survive long-term in crypto.
Go for it. Simon closes his analysis with this daily conditioning. Thinking probabilities, not emotions. I remain calm and disciplined in every market condition. I follow my trading system with precision and patience, waiting only for high probability setups. I respect risk management and protect my capital above all else. Losses are feedback that sharpen my strategy, and wins are the result of disciplined execution.
There's just a massive amount of behavioral science packed into that mantra, but the line that completely separates the professional from the gambler is, Losses are feedback.
Yes. Let's drill into that, because that specific phrasing changes everything.
In behavioral economics, there is a very well-documented cognitive bias called loss aversion.
Mm-hmm.
Studies by Daniel Kahneman and Amos Tversky proved that the psychological pain of losing $1,000 is literally twice as intense as the joy of making $1,000.
Wait, really? Twice as intense?
Yes. And because of this biological hardwiring, a gambler reacts to a trading loss as a personal attack. They think, the market stole my money, the system is rigged.
And that triggers the worst possible reaction. Revenge trading.
Exactly. The pain of the loss is so acute that they immediately abandon their system, double down on their leverage, and jump back in blindly just to force the market to give their money back.
They just completely lose it.
Yeah, they're operating purely on anger and adrenaline. And that is exactly how accounts get liquidated.
It's like the car is out of gas, sliding backward down the hill, and they are just stomping on the accelerator in pure rage.
It's the perfect way to visualize it. But to a professional who has internalized this VIP mindset, a loss is entirely depersonalized. It is just a business expense. It is a data point.
Right.
When a professional takes a loss, the mantra kicks in. Losses are feedback. It simply tells them, okay, my thesis on that specific Elliott wave structure was slightly miscalculated. The MEZ divergence was stronger than anticipated. Let me adjust the parameters of the system.
So there is zero emotional weight.
None. It just sharpens the blade.
And for you listening right now, this is exactly why adopting the specific Paradise VIP mindset is your absolute best shield against the anxiety and the pure chaos of the crypto space.
Without a doubt.
You don't have to be the herd clustered at $74,000, anchored to a psychological number, just hoping for a miracle. You can learn to read the sonar. You can wait for the deep exhales, manage your exposure, and trade based on strict probabilities instead of your pulse rate.
It is the ultimate transition from hoping the market blesses you with a lucky break to systematically extracting wealth from the market, regardless of the conditions.
Okay, so what does this all mean? Let's bring this entire deep dive together.
Yeah, let's recap.
We started by looking at the mechanics of a billion-dollar ghost, a 15-year dormant whale dumping 12,000 Bitcoin, and we realized that smart money doesn't trade on hope. They hunt for the liquidity provided by panic retail traders.
Right. And then we translated the raw charts into human psychology. We unpacked the Elliott wave breathing patterns, understanding that a complex WXY double 3 correction isn't the sky falling. It's just the market exhaling to prepare for the next surge.
Exactly. And we looked at the MACD indicator to recognize when the car is running out of gas, actively fighting the dopamine urge to keep our foot on the pedal.
Which is so crucial.
And finally, we mapped out the professional playbook. We abandoned the ego-driven need to catch falling knives. We have strict parameters now. Either we accumulate strategically in the ultimate liquidation zone down to $44,000, or we gladly pay a premium for undeniable structural confirmation from the bulls to ride the wave to $169,000. We depersonalize our losses as feedback. We think in probabilities, not emotions. And by aligning yourself with this MyCryptoParadise philosophy, you are quite literally swapping a gambler's anxiety for a professional's peace of mind.
You are rewiring your brain to operate alongside the smart money rather than being hunted by it.
Absolutely. So I want to leave you with this final thought to mull over.
Yep.
The next time you are staring at the charts, the price is violently swinging, your adrenaline is spiking, and you feel that overwhelming, deeply emotional urge to just smash the buy or sell button because you are so afraid of missing out. Stop.
Just pause.
Take a breath and ask yourself, are you acting as the professional, executing a cold, calculated plan based on risk-adjusted probabilities? Or are you just blindly swimming into the order books, providing the liquidity for someone else's billion-dollar meal?